All right, it's the last Wednesday of the month, and that means on Rule Breaker Investing, it is mailbag. As I've always said, it is your mailbag because we do this for you. You send us questions, and it's not just I always bring in a cast of all-star fools, which I've done once again this week. We do our best to answer your questions. So get ready, get started. Rule Breaker Investing mailbag this week on Rule Breaker Investing.
It's the Rule Breaker Investing Podcast with Motley Fool co-founder David Gardner.
Welcome back to Rule Breaker Investing. Happy Wednesday. This podcast tends to come out on Wednesdays, Eastern U.S. time, around 4 or 5 p.m., but you might be in a different time zone, a different day altogether, or perhaps you don't listen to this podcast when it comes right out on the wires. Perhaps you wait a day or two, or it's your jog on Friday, or maybe we're a weekend pleasure for you. Well, we're here once a week to educate, to amuse, and to enrich, as we said from the very first days of the Motley Fool, or as we articulate our company's purpose today, my podcast has the same: to make the world smarter, happier, and richer. So I hope we can do all three of those for you this week. Well, it's been a motley month of March. Looking back over the podcasts, we kicked off the month with our Mental Tips, Tricks, and Life Hacks, Volume 4. And then the second week, we talked about ESG investing, environmental, societal governance. People focused on socially responsible investing. Does that work? I tried to speak to that fairly emphatically on the podcast that came out March 13th. And then last week, it was the Market Cap Game Show, Episode 7. Always fun. Once a quarter here on Rule Breaker Investing. Emily Flippen starring once again in this month's Market Cap Game Show. And I've got a few hot takes to share from Twitter before we get into our mailbag points. One comes from Austin Lieberman at Austin Lieb on Twitter. Austin, you wrote, hoping I'm secretly playing, in parentheses, and beating David G. Fool, that's me, or my brother Tom Gardner Fool, or my other Motley Fool friends in their new investing mobile app game that's in beta. It's lots of fun. TMF Roger has been a blast to work with. Well, thank you very much, Austin. Now, regular listeners of this podcast know that we are building a mobile game to make investing more popular, a little bit more mainstream, but really at its heart, it's not trying to be an investor simulation, anything like that. It's trying to be a really fun game. And I've had a lot of fun playing the game. Austin, I'm not sure I saw you on the other end of any of my duels over the past few weeks, but a lot of you listened. A couple of months ago when I put out a beta invite through this podcast, we had over 100 beta testers. I hope you had a great time. Austin, I'm glad you did. We're even still discussing what the name of our game is going to be, but I know we'll have a chance to put out another beta invite in a couple of weeks as we take in the feedback that we got from you all a few weeks ago, tweak things a bit, and try to make it better as we keep developing what I think we might call Investor Island, but we'll see. We've talked about Stock Star, Stock Gods. There's different names that we have in play here at The Fool, but I kind of like Investor Island because that's what we're doing. We're on an island. We're having some battles with fireballs. There's like a tiki god statue in the middle, and it's all powered by stocks in the stock market. So anyway, thank you, Austin. And then Philip Silvera at Phil S1021 said at RBI Podcast, just heard the Life Hacks pod. Great stuff. Wife and I like to mentally double the cost of any new purchase to account for foregone savings opportunities. Worked well when we still had student debt to pay off. Example, is that $150 coat worth $300 to you? Wrote Phil Fool on. Well, I really like that. I love mental tips, tricks, and life hacks, especially, Phil, things that help us think better about money. So I really like that one. Cheers. Thank you for contributing. So those are a few hot takes from Twitter reacting to the month that has been March 2019. But now, without further ado, let's get into it. Mailbag item number 1. This is from Randy Stevenson, writing from Venice, Florida. He said, hi, David. I've been following Motley Fool since the AOL days. I have to add before we go on, hashtag awesome. I've been a subscriber to Hidden Gems and currently to Rule Breakers and Stock Advisor. Thank you for enriching my family these decades. That always means a lot. Thank you, Randy. One of the characteristics of rule breakers is strong past price appreciation. Please explain what this is and what metrics or sources of information are used to find these companies. Thank you again, Randy Stevenson. So this is a quick one for me, Randy. Yes, you're right. One of the 6 attributes that we look for finding rule breakers is strong past price appreciation. Now, back in the day when I was first dreaming up this approach, and before we even wrote it in our first book, Rule Breakers, Rule Makers, where I really first talked about rule breaker investing in book form. But back in those days, I was using Investor's Business Daily, the newspaper, which for years has, I think it's still present tense, but I don't really use IBD that much anymore, has printed what's known as a relative strength score, which is kind of a 0 to 100 indexed view of how well that stock has done over the last 3 months. So for example, if it was a 94, that means that stock has done better than 94% of all other stocks on the market. It's kind of like if you were really good in your math SATs and you were 94th percentile. It's the same thing for judging price movements of stocks. And I like to look back around 3 months and just kind of see how stocks are doing, which stocks are doing well. More broadly, though, Randy, primarily for this attribute of rule breaker investing, I just look for a stock that is doing well, that's going up. I like to find, I think the winners keep on winning. I know you know that from me. And so I don't necessarily use IBD's relative strength ratings anymore. I just kind of look at the stock and I say, hey, has that beaten the market over the last 3 months? Or maybe some cases it's doubled over the last year. And again, I think the key point here is a lot of people look at that and say, well, I'm not going to buy it now because look how well it's already done. Or I missed that double over the last year. But we, as rule breakers, generally feel the opposite way. And this trait is there to teach you and to train you to think in a winning way, I think, about rule breaker investing, where we look for stocks that are doing really well, because that's the market telling us that this company is onto something good and doing great stuff. So, Randy, I hope that's helpful. There's no hardcore metric I use. In fact, when I Googled relative strength, which you can do from the comfort of your own home computer or mobile phone, you'll see a lot of sites that have it define it differently, and a lot of them are about charting and technical analysis, which are so-called tools, and I do that a little bit with a smile on my face, that I never use and actively try to avoid. I don't look at charts, and I don't believe that there are patterns that tell us where stocks are about to move. I realize there's a whole industry dedicated to that, but that can bedevil people. So don't start necessarily Googling relative strength and start using those sites, at least in my experience, to guide you toward good investment decisions, because often I don't think that they will. All right, Rule Breaker mailbag item number 2. This comes from Luke Joseph, writing from Sydney, Australia. Luke, thank you for being a Rule Breakers member. And yes, I do tend to prioritize questions from members on this podcast. Now, we welcome all questions here at the Motley Fool, and we truly are trying to make the whole world smarter, happier, and richer. But when somebody tells me, Randy Stevenson, that he's been a member since our AOL days, or Luke Joseph, that from Sydney, Australia, you're a Rule Breakers member, there's a little bit of me that pushes you to closer to the top of the queue. So anyway, Luke, great question. You said, I'm fully on board with the Rule Breaker style of investing. I've done well with many of your recommendations over the past 3 years. Like you, valuation is not usually a primary consideration for me when selecting whether or not to buy a stock. I usually prioritize, Luke writes, a company's revenue growth rate, total addressable market, and proportion of recurring revenue. And I like all 3 of those. Those are good things to look for, Luke. I have no problem, you go on, with paying upwards of 10 or even 20 times revenue. So the market cap of a stock would be 20 times the sales, which is quite a high number. It looks high even to us, but we have similarly, Luke, had no problem in some cases doing that for a fast-growing enterprise software business, you write. However, I've noticed that sometimes fast-growing biotech companies can sit on a much higher valuation than this for a very long time. I'm thinking specifically of Guardant Health, Abiomed, and Mazor Robotics before its acquisition, which often had a price-to-sales ratio above 30. I seem to have a problem paying this much for a business because I don't know why biotechs seem to be able to levitate on such high valuations for so long. Is it because they often have monopolies, or is it because investors know that patients will have no choice to buy their products eventually? I would appreciate if you could assemble a dream team of Carl Teal, Aaron Bush, and yourself to explain why this is the case. Kind regards all the way from Sydney, Luke Joseph. Luke, delighted to have your question, and it is my pleasure to bring together the very dream team, Aaron Bush, that he just called out.
I'm so humbled to be on a dream team, period. Thank you.
So am I. I've never been on one before until now, but this is why we have a podcast, so we could just make ourselves a dream team.
Yeah, we should do this more often.
And I want to say hello to Carl Teal, calling in from his home somewhere in and around Austin, Texas. Carl, how you doing?
I'm doing well, thank you.
Good. Well, Carl, you have made some great biotech selections for Motley Fool Rule Breakers over the years. Aaron, you have done a wonderful job picking stocks, many different types of stocks, both in Motley Fool Rule Breakers and other services too. Luke wants to hear from you guys. I want to hear from you guys. Aaron, I'm going to kick it to you first. What do you think about when you look at a stock that's trading at a really high multiple of sales?
Well, I would say everything is relative. A high multiple of sales probably indicates that a company is growing quickly, that people have high expectations, and that's typically a very good thing, actually, because it means the company is doing things right. Probably means that they're in a large market. And in some cases, it actually is a reason to look deeper. I think sometimes there's a difference between when a stock is overvalued and when people say it looks overvalued. And I think a lot of times when you start seeing a lot of people say that a company is overvalued, and that is almost like the typical sentiment at any given time, even when a stock is trading at 20 times sales, it often shows, just based on what I've seen, learning from David and Carl, and seeing lots of rule breaker picks over the years, it often shows that, if that company does turn out to succeed and continue growing at fast rates for longer than people realize, that some of those people who think that it is overvalued, they might change their minds. And in some ways, the act of them changing their minds is what can push that stock up even higher.
And that's why attribute number 6 of rule breaker investing is when people call out a stock as overvalued, that makes us bullish. Now, Carl, you've specialized a lot in biotech. Do you have any particular biotech thoughts for Luke?
Yeah, absolutely. I mean, I guess stepping back and being a little more basic about it, I mean, one of the reasons is because biotechs, and it's not just biotechs, but they're a good example, have extraordinarily high margins. So they're always going to have a higher price to sales multiple. I mean, just an example of, say, a grocery store chain that tends to get a ton of revenue but make very, very little profit on it. They're going to trade at, probably less than one-time sales. A company with extraordinarily high profit margins is always going to trade at a higher multiple of sales. That's just a very basic reason. But another reason, is ultimately a company is worth what the market thinks it's worth. And it's been shown time and time again that biotechs, and I think kind of particularly sort of smaller and mid-cap biotechs, will command takeout prices that are at these kind of price-to-sales multiples. And just that is a real grounding in reality of what is something truly worth to somebody else. You see that happen particularly with companies that are also expected to see those sales grow very quickly. And that's why you'll tend to see these multiples be higher for, like I said, smaller and mid-cap companies. Yeah,
and I would say you do see similar attributes in the software industry as well. It's probably less explosive, less binary in a lot of ways, but there are some similarities in the sense that this is a trend that is taking over workplaces. A lot of these companies are adapting these technologies very quickly.
In enterprise software, you're talking about.
Yes, in enterprise software. So lots of companies are jumping on board very quickly. It's very sticky. So once they're in, they're staying in. And what we're seeing a lot nowadays is what we consider like a net expansion rate. And these companies literally are spending oftentimes 20% or 30% more the next year, just on upgrades and all sorts of things. And when you look at these software companies at scale, they also are very profitable. Potentially, 30% of their revenue turns into cash flow. So I think we're seeing high price to sales ratios because of not what their economics look like today, but what they will be many years from now. So instead of really thinking about that one ratio, I think it's more interesting just to look at the market cap itself and think about what could that market cap be at some point in the future, and then hopefully if you can think of a much bigger number than today's ratio is of less importance.
And that's why we play the market cap game. We've even made that into a game show on Rule Breaker Investing, because I agree with you, Aaron, that market cap is a really helpful guide for us. Now, Carl, I also have kind of a second question I'm just going to thread into this same point, but Colin Anderson wrote in, and he was talking about how he also loves Rule Breaker Investing, but he does look over his portfolio and he sees a number of his companies like MongoDB or Square or at different stages Shopify with negative earnings. Companies that do not have a price to earnings ratio because they do not have earnings. Is this kind of the same consideration again, just like a multiple in this case that doesn't even exist? But should we feel comfortable owning these companies? And which companies with no earnings would you prefer to own over the other ones that you wouldn't want to own?
Right. So obviously a company that never earns money is not a worthwhile investment. So every time you see a company that has negative earnings and is positively valued, that is on the assumption that it will eventually start earning money or start producing cash flow for its investors. And the numbers can be tricky, right? I mean, a company that's just turned profitable, produced 3 or 4 pennies of profit during the last year might have a price to earnings ratio in the hundreds all of a sudden. But, what you're looking at is how quickly is this going to grow into something? And particularly as a company sort of first steps into profitability, that can happen extraordinarily quickly, which is why it is good to look a good ways ahead and think about not what our earnings today, but what our earnings going to look like.
Yeah, one topic that venture capitalists and particularly pay attention to is the idea of unit economics. So less of like what are the economics of the entire company at one point, but what are the economics of acquiring one user and then their lifetime value and the value that they bring to the company.
So that's unit economics, where you just take like a single customer and you see what is the economic dynamic around that customer, and then you project it out to others.
Right. So it's just another way of looking at what could their economics be in the long run once those unit economics start becoming the norm for everybody.
And people do that with retail stores too. You might look at a single Potbelly or a single Starbucks back in the day and go, what if there are a lot more of these? We could maybe make some better projections about the value of that entity.
Right. So there are different ways to slice and dice the numbers, but I do think unit economics is particularly helpful when companies are losing money.
All right. So there are some thoughts from 3 different rule breakers. One man's dream team, if you will. Aaron, Carl, thank you very much.
Thanks, David.
Thank you.
All right. Rule breaker mailbag item number 3. And this one comes from Bill Housley, who's written this podcast a number of times. Bill, it's my pleasure to feature your latest question, and I love this one. And in fact, I've pulled my friend in, Bill Mann here of Motley Fool fame. Bill, welcome.
How are you, David?
I'm doing really well. And you and I have both looked over this question from Bill.
Yeah.
And it's one of the more interesting ones that we've got. And we're going to speak to that in a sec. But Bill, I want to mention, I had said on my podcast to my listeners a few weeks ago that I taped early because we went skiing.
Yeah.
And one of the things about that ski trip in Snowmass, Colorado for me this year is that my son, who'd broken his leg, a compound fracture, got back up on skis for the first time in 3 years. And it was pretty great to see him out there. Bill, I believe my son Zach is not the only one who had a compound fracture from skiing in the last couple of
No,
months.
it wasn't so much the skiing. It was more the falling that did it. But so I was going 62 miles an hour when I fell. And this was the day before the Atlanta, New England Super Bowl. And I was so doped up during the Super Bowl that I thought that I was actually controlling the game. So,
oh my gosh.
I don't know if you remember all of the weird things that happened in the game.
I do. It's an incredible second half.
Yeah, you might wonder where that came from. It
was you?
It was my magical powers.
All right, so Atlanta, New England, this all runs together in my head. But Bill, what month was that?
Yeah,
was that
February of 17.
17,
Yeah.
right? So here you are 2 years later. So how long did it take you to convalesce? Are you back?
I am. So I started really exercising again in about October of this last year. So it was that kind of, maybe I waited a little too long to start exercising
You
again,
look good.
but it hurt, so, and doctor finally said, look, it's going to hurt. And maybe your son's gone through the same thing. Like, it is going to hurt, but you just kind of need to play through to the other side. And he was right. So
It didn't affect your stock picking skills, though.
yeah, that's right. Unfortunately, I didn't quite have the same prescience with, because I pretty much nailed that Super Bowl.
Are you going to ski again?
Yes, I'll ski again. I didn't ski this year, simply timing and nervousness, but I love the sport and will look forward to doing it again.
Awesome. Well, Bill, thank you for joining us on Rule Breaker Investing. And so Bill Housley's question, he said, "Dear Dave, this is short." He said, "This belonged to my great uncle. I've discovered this company was eventually sold to Union Pacific. I don't know what to do with it." And Bill includes a picture of a stock certificate, and the company is Chicago and Northwestern Railway Company. And like a lot of these certificates, this is a beautiful piece of art.
Gorgeous. Yes, and this is from the 1930s. 1937 is when it was executed. So obviously the company doesn't exist anymore, but there are plenty of places where this stock certificate itself, particularly if it's in good condition, could net Bill a lot of money.
Is that right?
I would take it to any coin and stamp store, because one of the things that they also will do is they will deal in old certificates. It's called scripophily, the collecting
SCRIPOPIPHILY. Scripophily.
Scripophily is the collection.
.com?
Yeah.
Okay.
.com.
Yep.
Yeah. Collection of stock certificates. But yeah, so I actually recently on Scripophily bought a share certificate just like this from my grandfather's company, which is called Cannon Mills, which is a textile company from Kannapolis, North Carolina. So yes, I can speak to this both as someone who loves collecting these kinds of things and just loves old stock certificates, but also as someone who has recently been on the other side of this transaction.
That is a great reminder, because truly, as I read Bill's question, first of all, I haven't had this experience, so I'm like, I got to have an expert in from the Motley Fool, and we get Bill Mann this week, which is awesome. But I was just thinking, hey, maybe Union Pacific paid something for this company that's decent. Union Pacific's still around, so maybe this is worth a lot of money. But you're pointing out that whether or not that's true, and it might be, the artwork itself and collectors, there's a whole market out there for these kinds of certificates.
Yeah. So there is something called the Escheat rules. And so probably if this has been sitting around, what Escheat is it says that after a period of time, the company might consider the shares abandoned. He should absolutely check with Union Pacific. I'm guessing that they have long ago struck these shares from their register.
I see. So this is not actually, you're not going to find out that you're a millionaire. Because these were abandoned. They were not claimed. This was 1937, I see. We are 82 years later right now. So so probably there's no stock market value to this. You can't claim 1% ownership of Union Pacific at this point.
Right. Highly unlikely. But it's worth checking. Union Pacific might want to get their hands on this stock certificate. They might think that that's a pretty cool thing. But it would be fabulous. I hope Bill lets us know what happens. But I think of it more in terms of, because of the Escheat rules, I think of this as what a collector would do with it. And I guarantee you that's not worth zero.
Really cool. Last question for you, Bill, before I let you go. I'm not asking you how much you paid to buy that certificate, but typically I'm sure a lot of us are wondering, what is a typical price for a handsome piece of art, an actual stock certificate from 80 years ago? Are these $500, $1,000? Are we talking a lot more than that or less?
Certainly can be. And what Bill has in his hands is something that's very special, because there are railroad collectors, so railroads and power companies and things like that, but especially the railroads. The other one that tends to be worth a lot is old Disney certificates. They can be upwards of $500. So I'm really curious to know what comes of this.
Awesome. Thank you, Bill.
No problem, David. Good to see you.
All right. Rule breaker mailbag item number 4. And oh my gosh, is this Emily Flippin in the studio? And is she here to give a tip to market cap game show players? Emily, welcome.
Thanks for having me again.
Well, Emily, I'm looking at some of the hot takes we got from Twitter, and a number of them said something along these lines. This was from Don Karpik at Tokyo Boiler. Emily Flippin is amazing. Hashtag I lost to Emily. Or Fusco at Fusco for Real says, considering that one of Emily's stock recommendations is the best performer in my portfolio this year, I bet y'all gonna lose to Emily in this game. By the way, just listen to yesterday's Market Foolery podcast with Emily on. Always delivers the goods. So Emily, I thought, the people are calling for this. I had to have you back for an encore this week. And thinking about your outstanding performance in the first 2 episodes that you've been on the Market Cap Game Show, I thought maybe you could just share a tip or a pointer to somebody who wants to up his or her game at the Market Cap Game Show.
You mean somebody who wants to beat me next time?
Yeah, people, and there was at least one person who did go, hashtag I beat Emily, could I be
Impressive.
on the show?
Well, I've said it on the show before. And, you know, when you're looking at market caps, I think the most important thing and the thing that's helped me the most has just been to internalize whether or not that stock is a small cap, a mid cap, or a large cap. And honestly, if you own the stock and if you're somebody, you know, like an analyst here at the Motley Fool who spends their entire day looking at companies, you probably already have a good idea about your investing thesis. And that investing thesis probably depends on how much growth that company has ahead of it. So you may already have a sense about the size of the company, even if the market cap to you is just some vague number, but you know, oh, this company is a small company operating in a growing area. That means a lot. And that actually gives you a great starting point. And I will say a 20% range is generous. But when you're looking at companies, all day, every day, it's an unfair advantage.
I guess that's probably true. And that is your job. And most of us are just playing at home as we have other jobs. So it's understandable. But that's a great point, Emily. And I guess my only follow-up there is, how do you personally, what numbers do you use for small, medium, and large? I realize there's different ways and different parameters people use. How do you frame things up?
I think especially when I'm looking at companies with the intent of going on something like the Market Cap Game Show, anything below a $5 billion company, I think I say is a small cap. Mm-hmm. Anything under $100 billion, mid cap to me.
So that's a big range, 5 to 100
range. It
for
is a
mid
huge
caps.
range.
Yep.
But yeah, so there's a big difference. You're right. There's a big difference between a company that maybe is like Match.com and it's closer to 15 billion and something that's, you know, closer to 70,
T-Mobile
80,
or something.
exactly.
But
you can also think about those companies. I mean, you use Match and T-Mobile as an example. I mean, you as a consumer probably have a sense about how big those companies are just using them in your everyday life.
Who advertises more on television at Super Bowls?
Exactly.
I would say T-Mobile probably more than Match, right? That's so horse sense. I love it. And, you know, I'm going to go on to the next mailbag item, but would you hang around for that one, Emily?
Yeah, of course.
And before we go to number 5, I do want to mention one other. This might have been my favorite tweet to us in the past month. This comes from Fergus Cullen at Fergus Cullen. This hooks right into the Market Cap Game Show. Fergus wrote, played the game using http://marketcapgameshow.com. Fergus says, with high school investing club I work with. Educated? Checkmark. Amused? Checkmark. Enriched? Working on it, he writes. High score, got 6 out of 10. So why do I love that tweet so much? Because it reminds me that Clay McKinney, one of our listeners and a talented programmer, created, inspired by our podcast game show, marketcapgameshow.com. And anybody who wants to up their game, just go to that site. Clay created it for you. And I love to think that Fergus is there with his high school kids that he's coaching using marketcapgameshow.com. What a world. All right, mailbag item number 5. And speak of what a world, love this one. Is this my favorite mailbag item of the month? Close, maybe. Real close. Awesome. Hi, it starts. My name is Jeff Pugh. I'm an actor in New York City, currently performing in Frozen on Broadway. I've been a subscriber to Stock Advisor and Rule Breakers for a few years and an avid listener to all of the Fool podcasts. Over the past year, I've been successful at converting 2 of my friends in the show to the Motley Fool way. We've enjoyed discussing stock picks, following the Fool's guidance, forming strategies on how to best position ourselves for the future. We are all currently beating the market thanks to you. Well, Jeff Pugh and friends, and really the whole cast of Frozen, and frankly, all of Broadway, thank you. Awesome. Jeff goes on, here's my question. Do you ever sell a position you've been holding for a long time to free up capital for a big purchase like a down payment on a house, down payment on a weekend house, investment property, renovation, new landscaping, college tuition, or helping a family member in a time of need? Ideally, we would all have enough savings on top of our investments to pay for these types of big purchases. But what if we don't? Is it okay to be holding some of our biggest positions with the intention to sell when we have enough money to achieve a goal we've been working towards for a long time? When do we use the money we've been earning? Jeff concludes, I love the Motley Fool. I've been listening to you and your colleagues long enough now that I almost feel like I know you. Thanks for the fantastic advice and education. Sincerely, Jeff Pugh. Now, Emily, I know that we're at different generations. We've established this. You are younger than I am. I would say by about a generation, because I have kids that are about your age. In fact, you were once a summer intern at the Motley Fool, and I believe at least one of my kids was that same summer. So we probably each have different perspectives, which is why I wanted to have you on. Now, I'm assuming you haven't had a lot of big lump sum kinds of payments or needs for your investing portfolio thus far.
No, have not been buying myself vacation homes just yet.
Yes, I appreciate that. But do you have any take on this? Just your thinking as an investor in terms of, like, if you have larger positions, should you be actively thinking about harvesting them near the time that you might want to buy that house or not?
Well, it's twofold. In general, I think it's fine to cut back on your larger positions or your portfolio as a whole if you need that money to make a planned purchase. I mean, that's what that money, and for many people, is there for. The flip side of that is you really shouldn't be doing it right before you need to buy a house, for instance, because if you're planning to buy a house in 3 years and you have all of that money invested and a lot of it into, a handful of stocks, when the market goes down and the
market, fourth quarter of 2018, for example, when a lot of our stocks lost a third of their value, even though a lot of them are back.
Exactly. So it's important not to be withdrawing your money when the market could be going through a downtime. So you should ideally plan to slowly transition that money out from whatever stocks, whatever holdings you choose into a safer vehicle for when you need that money in the future.
Thank you. Very well put. And I'll just add, Jeff, that, in a lot of ways, this is why we invest, right? It's not just a game that, well, it is a game. It's fun and you should try to win, but this is a game that has real world consequences. Often the reason that we invest is to do the things that you talked about. For me in my own life, I bought a house. I've done that a few times. I usually have sold off stock in order to buy that house. That's why I was investing. And really looking backward, it was some of my arguably worst financial decisions because some of the stocks that I sold have done far better than almost any piece of real estate could. So sometimes you're paying an opportunity cost for transitioning money that was in great stocks into a house that probably won't grow at the same rate as Netflix. But regardless, this is why we invest. So I don't think anybody should be shy about selling a large position in order to fund any one of those really key life goals that you articulated. But as Emily said, I do want to echo that as I approached buying that house, I knew it was going to be a house I was going to be buying in the next year or two. So I began to sell down positions. If it is going to be selling stock, you start doing it in advance so that you don't set yourself up for a really bad surprise last second as you hoped to fund something big and the market cowed. Now, I probably should move on to Rule Breaker mailbag item number 6, but Jeff included a couple postscripts, and I thought, I have to speak to these, and I have to have my friend Cheryl Palting back to this podcast. Cheryl, welcome back to Rule Breaker Investing.
Thank you so much. I love it.
Thank you.
It's awesome.
You totally get it, Cheryl. That's why I keep having you on. Let me remind our listeners again, Cheryl, what do you do here at the Motley Fool?
Yes. Hi, everyone. So happy to be back. I am on the recruiting team here at the Motley Fool. I also work very closely with our org dev fools, our learning and development fools, anyone basically on the people team, which includes communications, health and wellness, onboarding, a lot of fun stuff. We say that we're the fun side of human resources.
You sure are, and we do it right at the Motley Fool, and thanks to people, amazing people like Cheryl. And speaking of amazing, Emily, I don't know if you were there during Pi Day, when Cheryl began to recite digits of pi.
Oh, yes.
Extremely impressive. I mean, we had a couple people go before Cheryl who did a great run. And then Cheryl happens to get up. And she actually got cut off before she could finish all of the digits of pi she knew.
60 seconds to do the digits of pi. How many did you do?
I was 113. I think I said 115, but 113 before.
Right, which is amazing, and I'm definitely not going to ask you to replicate that. But how about just give us, the first 20 or so, just as you did it in front of our employees? Yeah,
I'll try and do it fast. 3.14159265358979323846264338.
Right, and I'm going to cut her off because at a certain point it's not interesting radio, even though it was amazing to see. At Fool HQ.
Someone listening will be like, let's Google this. Let's check this.
Well, I do remember, Cheryl, you were asked afterwards by a fellow Fool here, how could you possibly know so many digits of pi? And your answer was something about your family?
Yes. So I have a very competitive family. And whenever anyone says something like, I'm going to go do this, and they hear it and they're like, you can't do that. It turns into a competition and it gets out of hand. And so here we are now.
I love it. It's beautiful. Okay, so, but I wanted to continue with this remarkable email from Jeff Pugh because he went on to say this. P.S. This is our friend acting in Frozen on Broadway. Jeff says, I'm going to be applying for an internship at the Motley Fool this summer. I've asked my superiors at Frozen if I could be granted a leave of absence. They've said it's possible. As there are a few logistical issues to work through, I'm wondering if I could be so bold as to ask how long it would take to hear back from the team at the Fool, etc. If I submit this week, would I hear back in 10 days, a month, 6 weeks? He's literally trying to gauge the timing of his potential temporary replacement on stage at Frozen against the hiring timeframe of our Motley Fool summer intern program. And Cheryl, you are integral to that program. So I thought we had to feature Jeff's question. He does say he thinks Frozen may be his last hurrah in show business. He's ready to begin a new adventure. Jeff Pugh. All right. So Cheryl, two questions for you about that. First of all, what is our summer internship program? Should people still apply? How many people apply? Give us some statistics and perspective.
I just want to comment on this email super quickly. Jeff, this email is amazing, incredible. I can't wait to talk to him. We've actually already connected with Jeff. Very, very exciting there. Our summer internship program is closed to new applications at this time. However, if anyone has any questions, they can always email us at careers@fool.com, and we'll get back to you as soon as possible. For our internships, it's very, very, very competitive, and we always try and convey that in all of the communications we send out. Just as an example, from the top of my head, I know we received, just for our software developer roles, which we tend to have 3 to 5 maybe, we received over 550 applications.
Which
just
is
for
ridiculous.
Our software developers.
In fact, it made me wonder, I heard sometimes like Chris Hill on Market Foolery would put it out there, hey, apply for our program. We shouldn't tell people that because we're going to be turning away hundreds and hundreds of people, and it's amazing.
I think it's another thing to keep in mind with our summer internships is that if we find someone who's really, really amazing, we may have 8 people that summer, but who knows? We might say this person's really incredible. We need them here. All of a sudden, we have 9 interns that summer.
Yep.
One summer we had 12 interns. The following summer we had 15. I think for us, it's important to just get really incredible people in the door, show them our foolish ways, and then also learn from them.
Did Emily Flippin grade out well as a summer intern at Motley Fool 2016?
Oh my goodness. Emily Flippin,
I know she's here, so don't feel like you have to be nice. But you said game changer.
She's a game changer. I think Emily, from day one, we knew was going to be special. And we're so, so lucky that she's now here as a full-time, not an intern, full-time, beating records, telling our members everything they need to know to invest better, become happier, smarter, and richer. And we couldn't. It's an opportunity for us too to learn from her, and I think that's one of the best things about our internships is no matter how old you are, no matter what your experience looks like, you can learn, you can form bonds with people, and then really come out the other side as so integral to the company. And
That's
we're
great.
so happy.
Now, Emily, I do think you have to up your pie game. You're pretty good at market cap game show, but I think we've all seen we could up our pie game. Cheryl, before I let you go, let's broaden it just briefly because, yes, our summer internship program, where I'm regularly turning down like kids I coached in soccer and members of our family because we have really hundreds and hundreds of applications for maybe 12 to 15 positions each summer. But let's talk about, maybe I applied, maybe I got turned down, but I love it. And maybe I go through another year or two of school and now I'm an adult and maybe I'm going to apply for a job for real at the Motley Fool. So let's talk briefly about that because I know we're hiring more this year than the last 5 years, maybe combined almost.
Yes, we are growing like crazy and we're hiring people. We need people to come help us expand our knowledge bubble. So anything from marketing to editorial to investing to software development. I keep going back to software development, but we're growing. And so I encourage people, if you just are interested in working with us, helping us help the world invest better, become smarter, happier, richer, please visit us and visit our careers website at careers.fool.com. There you'll see a page for openings. There's over 40 open positions right now. So definitely check it out. And if there's nothing that really speaks to you at that point, you can always submit a general application.
Now let's say I'm sitting at home and I'm awesome. Would you encourage me to apply?
Yes.
Let's say I'm sitting at home and I'm really way below mediocre.
I would say still apply.
Still apply.
I think
so. We take applications from everybody, even non-awesome people.
Yeah, I think if you have a passion for what we do here at The Fool, go ahead and apply, because
awesome.
You don't have to have all of the credentials listed on the job description. If you, like Jeff, for example, he's an amazing person on Broadway. We don't focus on musical theater here, at least to my knowledge. But here he is applying for one of our internships, and we're excited to talk to him. So,
all right, good. So all are welcome, and you might even have better odds getting a job at the Motley Fool than getting a summer internship at the Motley Fool, but I wouldn't know. Anyway, so to Emily and to Cheryl, thank you both for joining us this week on Rule Breaker Investing.
Thanks, David. Thank you.
All right, now for something completely different. Hello, David. Brett Wham writes, as you probably know, the Motley Fool scorecard, that's our online tool on the Motley Fool site. Our scorecard has not reflected the versus S&P column for a few weeks now. That's like playing Monopoly without keeping score, says Brett. And let me just insert briefly that certainly it's always been true for us at the Motley Fool that we think you should be comparing your returns against the S&P 500. I like to use the market as the level index, the level set index that I'm trying to beat. And I think a lot of us have that mentality. We've coached our members to think that way over the years. So that's why Brett says that's like playing Monopoly without keeping score. No fun, he goes on. Anyway, since I add to positions every week, thank you, $0 commissions, Brett writes, it's been difficult to determine and add to the true winners every week. Can you talk to what happened and when we can expect to keep score versus the S&P? Again, thanks, Brett Wham. And thank you, Brett. And my friend Tracy Dahl talk about this ongoing cavalcade of all-star fools this week. Tracy, welcome.
Thank you, David. Brett, I do apologize that this has been a problem for you for so many weeks. And the timing of your question and the taping of this podcast is just spectacular or horrible, depending on how you look at it.
I know that you're really busy on this, Tracy, so I almost felt guilty pulling you away to ask you to be on our podcast this week, because I know you're working on these things.
Yeah, so I work with our tech team, and they are working on everything member-facing on our websites. They understand this is a big problem. And frankly, a lot of our data feeds haven't been as great as they could be for some time, especially as our business is expanding to other countries. We have Fools in Singapore now, which is tremendous, but we weren't able to get those global Fools great returns data, or they're just fundamental data through the provider that we had been using. And so right now, as we're talking, my tech friends are outside the studio working really hard to update our quotes provider. And unfortunately, this is going to require a little bit of downtime in some of the data that you guys are used to seeing on the sites. I like to think it's always darkest before dawn. So yes, that data piece on your returns versus the S&P 500 has been missing for a bit. More stuff will actually be missing for a tiny little bit, and then everything will become better.
All right. And Tracy, I really appreciate, again, you and the work that you're doing and your team, because you've got a large team working on this that you're helping to lead. So basically, the Motley Fool changed data providers. That's the big story here, right?
That's the big story. I was in a meeting about this earlier this morning, and it turns out our data provider has a data provider. So we're totally out of our depth here, David, you and I. But we are relying on a lot of third-party helpers, and some of this stuff is not anything that we have control over. So we're partnering with a new organization, and we're just trying to work out all the kinks.
Okay. So I know we're going to get there, but we're not seeing the light at the end of the tunnel right here as we publish on Wednesday, March 27th. Is that fair to say?
I think that's fair to say. I don't have a hard and fast ETA for you. Everybody is working tirelessly to get this right for you guys, and I know that data point in particular, so you guys can follow along with your own personal returns at home. That is number one in terms of data we want to clean up and fix for you as soon as we're able to restore all of those columns that you're used to seeing on our sites.
So maybe Brett Wham and his foolish ilk, maybe Brett use a spreadsheet temporarily or something like that to log your data in between the time we had one data provider and then transition to another. So it's not a decision we ever make lightly. I know that, Tracy, and we don't do it very often at the Motley Fool. We've probably changed our corporate purpose or mission more often than we've changed data providers over 26 years.
That's probably true.
But that is what we're doing right now. on. So Tracy, keep up the great work, and I hope the team will too. And Brett, thank you for writing in. And we know one thing, we're going to hear from you, our members, whatever we're doing, whether we're doing something really well, like a good stock pick or a bad stock pick of mine, or whether the tools on our site are working or not. So stay tuned. We're working on it. And Tracy, I want you to go back and get back to work again. Don't be on this podcast anymore.
Okay, I'm leaving. Thank you, Brett. Hang tight.
Rule Breaker mailbag item number 7. Is that David Kretzmann joining me here on Rule Breaker Investing?
Yes, it is. Good to be back.
All right, Rule Breaker mailbag item number 7. We're about to go to the Gardner-Kretzmann continuum, which recurs on this podcast from time to time. I'll have you explain that in a sec, but let me just go ahead and read this lovely note from Paul, who wrote, and he actually... He compartmentalized a few different sections. I'm not going to read them all, but there was a sucking up to David one, which I'm not going to read. There is, though, this one, which was entitled Sucking Up to Rick. And I would like to read this before getting to the meat of the question coming up. But he writes, also, this is to my producer, Rick Engdahl, Sucking Up to Rick. This section is called Also... Paul writes, as somebody who just recently started a podcast with some friends and is solely responsible for editing it, I wanted to give a special shout out to Rick. That's our own Rick Engdahl, as I have, Paul writes, a better appreciation for the thankless work that editing can be. When done right, Paul says, it seems like nothing was done at all. But when a mistake is made, it's out there for all to hear. Much like a kicker or offensive lineman in football, your work only tends to get noticed when something bad happens. Well, Rick Engdahl, I sure hope that that's not true on this podcast. I don't know that you've ever made a mistake, so I'm not sure you would have been called out like an offensive lineman is for holding. But Rick, did you feel emotional at any point during that read from Paul?
My condolences, Paul. Good luck.
Time to pull back the curtain just a little bit. Rick, one of the things I do frequently on this podcast is I stop deciding I could say it better, and then I start again, and I say something like this. That's it. 3, 2, 1. And I just retake, sometimes in the middle of a sentence. Now, Rick, roughly how many times on an average Rule Breaker Investing podcast will I stop and then restart to deliver this final product that you bring out every Wednesday?
I don't know of a solid number of restarts, but I'd say that I usually have about 150 edits in any show.
Okay, so I like to think I'm not 3, 2, 1-ing 150 times, but I might be doing it dozens and dozens, possibly up to 150 times. I'll let Rick... But anyway, so that's pulling back the curtain on the onerous work that Rick Engdahl and his ilk do as podcast producers. Paul, you know it because you're doing a podcast and you're editing it too. But anyway, I love the Sucking Up to Rick section. We had to share that moment. Thank you for making that possible, Paul. All right, now to the question at hand, David Kretzmann. Paul writes, I had a question about the Gardner-Kretzmann continuum. I'm 38 years old, he writes, with a GKC score of around 0.7. And if anything, I would like to make it lower. I had read in the past that individual investors tend to perform best when they stick with their highest conviction ideas, and expanding beyond that tends to dilute performance. That makes sense to me, Paul says, and it's why I've always tried to stick to between 20 and 30 companies. That also seems to go with the rule breaker philosophy to me. Why would I want to invest in my 31st best idea when I could just add more to my 2 or 3 best ideas? So can you tell me where I might be wrong, why more positions are better? Thanks again for all that you do, Fool On, Paul.
Awesome question. And I think it's something that we repeat a lot of times on this podcast and other podcasts. Your mileage will vary depending on your own situation, Absolutely. Your own preferences, risk tolerance. So there's not necessarily anything wrong with having a GKC score below 1, which Paul, in this case, has. I think most individual investors should shoot for a GKC score of about 1, just to be thinking in terms of broad diversification within your individual portfolio.
And let me pause you right there, David, because I know we have some new listeners since we last talked about the GKC, which we seem to do every month or two on this podcast. So could you briefly define our term, the Gardner-Kretzmann continuum? What does 0.7 mean?
Sure. So the Gardner-Kretzmann continuum is probably lapping its 1-year anniversary at this point, if I'm not mistaken.
I've heard rumors that it's being considered for the Nobel Prize in Economics. It's put
excellent.
Both Gardner and Kretzmann in a position, I'm not going to say a pole position, but potentially to win the big bling, that hunk of metal that I always imagine the Nobel Prize must be. Obviously, modesty can sometimes escape us, but David, What is the Gardner-Kretzmann continuum?
Sure. So this is really a simple score. So you take the number of stocks that you own in your portfolio and you divide it by your age. So as an example, let's say you own 50 stocks and you're 25 years old. Your GKC score is calculated by dividing the number of stocks that you own. So in this example, 50 stocks divided by your age, 25 years old. So in this case, your GKC score would be 2.
Above 1.
Above 1.
Well above 1.
Yeah.
That's remarkable. So you have a lot of stocks given your age.
A lot of diversification for your age. So if you're 50 years old, you own 50 stocks, your GKC score is 1. And generally on this podcast, over the past year or so, as our GKC score has evolved, David, you and I have thought, well, maybe you don't need to aim for just 1, but ideally 1 or higher.
Yeah,
and really,
1.0 is kind of the golden mean. And the way of thinking about it is, if you're 25 years old, maybe you should have 25 stocks. I'm 52. I have about 52 stocks. There's no one way to go here. That's why it's called the Gardner-Kretzmann continuum.
And some people will be below 1 and they'll be perfectly comfortable with that.
Like Paul.
And to Paul's point, the question of, is it okay to shoot for 20 to 25 stocks? There's kind of the Warren Buffett adage or quote that's out there where he says, you should really treat buying stocks like you're punching a card where you only have 20 boxes to punch or check, essentially meaning that over the course of your life, invest as if you're only going to buy 20 companies. And I think the meaning behind that quote is to really focus on buying quality, great businesses that you want to own for a lifetime, which is something we aspire to do as fools. But on the flip side, in our recommendation services like Stock Advisor or Rule Breakers, or really since the Motley Fool launched with you and Tom over 25 years ago, the focus has really been to continue following and recommending stocks week by week, month by month, and really trying to continually explore the world of business out there.
Absolutely.
And try to find all the quality businesses out there. So I think now in Stock Advisor and Rule Breakers, we've probably, recommended over 300 companies over the past 2 decades
Many
or
of
so.
which remain active recommendations. But yeah, and in my experience, David, now in our 3rd decade of the Motley Fool and having been there at the very start, having met so many individual investors of all stripes in many different countries. And David, you're now head of Motley Fool Asia, so you especially know that better than I. But in my experience anyway, the mistake most people make is they are not diversified enough. They do not have enough stocks. So it makes me far happier to see somebody with a lot of stocks than with just a few stocks. And Paul, I think 0.7 is just fine. You sound like a savvier guy at the age of 38. You've got less than 38 stocks. And if that's working for you, that's great. And if you want to keep adding to your winners, we like that too.
Yeah, absolutely. And I think that this is all directional more than anything, trying to think in terms of more diversification, not less, especially for beginners. I think that a common mistake is to only buy 1 or 2 or 3 stocks. And that way you're just so emotionally invested in those companies. You're more likely to follow short-term movements in that case and potentially get spooked out of the market or just get the wrong idea that, hey, one of my stocks jumped 30% this month. I'm really good at this. I'll just keep doing this, rinse and repeat. So,
yeah.
And I think one of the benefits also of owning more stocks is it just encourages you to pay attention to the world maybe a little bit more closely. Your portfolio doesn't get stagnant. So even if the new stocks you're adding represent less than 1% of your portfolio, you get a little bit of skin in the game and you can follow along, especially with a year like this where you have a lot of new companies coming public. You have Lyft and Zoom and Uber and a bunch of different companies.
Pinterest.
Hitting the public markets, Airbnb. So having skin in the game, I think, encourages you to follow along like an owner and can make it a little bit more fun.
Absolutely. So again, thank you, Paul, for a great question. And there is no one size fits all. That is why it's the Gardner-Kretzmann continuum. And we, of course, have fun with that. But we're deadly serious about the point. Each of us should be maintaining a well-diversified portfolio. And that phrase can mean different things for different people at different stages of their life. All right. Well, the last 2 points on mailbag this month. David, please hang around.
Sure.
But, I have a poem to share and then an inspirational story, and that's how we're closing it out. So, David, if you're moved to tears by the poem, I want you to let people know that.
Absolutely.
Or if you love the story at the end, maybe you'll have an insight. So, Rule Breaker mailbag item number 8. Now, this comes from Alden Dyer, who wrote a very thoughtful note as a younger guy talking about perceptions about capitalism and business among people his age, reacting to some of what we've been talking about in the last few weeks on the podcast. What about socialism? What about capitalism? And Alden, I don't have time to share your very thoughtful and well-articulated arguments here, but I did have time to share the poem that you wrote at the end because we like poetry on this podcast. So thank you for a great long note, Alden, but let me share your creation with David Kretzmann and all of our fellow rule breakers. You wrote, after saying, I've also written an investing poem. Invest. It's the best. You might not beat all the rest, but build up that egg to bring back to your nest. Bring up that leg and get a leg up. With just one sip and with just one sup, you are off with a zip, and you're doing quite fine. You've built up a treasure from pennies and dimes. It gives you great pleasure and compounds over time. Security is achieved for yourself and your kin. Our posterity are relieved, although not that quick. A foolish win, helping them through thick and through thin. Saving up money not only helps you, at first it seems funny, but it helps others too. It helps us help others like we want to do, so that you may help others, not just one or two. I say it helps us have fun and get through. Thank you, Alden, for your poem, Invest.
Alden or Dr. Seuss? I'm not moved to tears, but I am moved.
There was a little bit of, oh, the places you'll go. Maybe it's how I read it. And I think I've established before, I don't even like the book, Oh, the Places You'll Go. That's my least favorite of Dr. Seuss's works, even though I know for many people it's their favorite and they give it away as a graduation gift to somebody. Anyway, I think we both love Theodore Geisel's creations, and I love that you saw Seuss in Alden's work and early Geisel. All right, and finally, this month, mailbag item number 9. This one comes from Christian Belko. Hi, David. I wanted to thank you for stressing the importance in holding on to stocks, even your losers, as a part of your portfolio strategy. I listened to your methodology and I kept holding a small position in the company that I thought would do well. I did my homework. The company had a good balance sheet as well as some promising things on the horizon. But because I bought the stock at the higher end, it had never recovered back to where it was at its high cost basis. Nevertheless, Christian writes, I decided just to keep this position and ride it all the way down to zero if it came to pass, using it as a lesson learned. So imagine my surprise, Christian continues, when I looked at my, quotes, loser stock on a Monday morning, only to find that it was up over 120% from its close the previous Friday. That stock for me was Spark Therapeutics, ticker symbol ONCE, and it not only made back my original investment, but the $114.50 a share buyout allowed me to cash out this at an all-time high and have new money to reallocate for other investments on my watch list. So, thank you for helping me learn this lesson. I've learned that with time, patience, and a willingness to let your losers run, your biggest loser can turn into one of your bigger winners. I look forward to seeing what my other, quotes, losers will do in future. Thank you, and Fool on Christian Belko.
Patience is a powerful thing. Not all losers turn into winners, and not all winners are guaranteed to be future winners. I know, David, your style is really built on the idea of actually adding to your winners, not just holding them, but actually adding to them. But especially in the world of biotech, sometimes you'll see these wild short-term movements when there's a buyout announced or a drug gets approved or a drug doesn't get approved. You see some really volatile short-term movements.
Yeah, I think what happened to Christian, none of us should expect that would happen to us. Because at least for me, I've invested for a long time, and I'm happy to say we've got some winners there in our Rule Breakers and Stock Advisor portfolios. But I don't think I've ever had a 120% premium buyout for any stock that I've ever held here at the age of 52. And for it to be, in Christian's case, a significant loser and flip to a magical, truly magical winner, I don't think that's something I would expect to happen again anytime soon, Christian. But your point, and David, your point to Christian's point about patience and being willing to hold, sometimes it can all come up roses.
Yeah, I would look at Chipotle as a recent example where, you had the share price over $750, I think back in 2014. Then you had the health scare with E. coli, and just it seemed like there was constantly pessimism surrounding the company. The share price went down to below $250 a share. And today, as we tape this, I think it's set a new 52-week high at $680 a share. So It can pay to be patient. And certainly, there are some investors who I would say specialize in looking at some of those beaten down situations. And sometimes you can find a gem in the rough. But I think at the very least, it's worth being patient, especially when there's a company there that has a demonstrated long-term track record of success, like Chipotle had for many years and even decades, to stick with it, even if it takes a few years to recover.
David Kretzmann, well put. Thank you for being my final guest star on this week's Rule Breaker Investing Mailbag. Next week, well, every 10 episodes or so, I pick stocks. I call them my 5 stock samplers. I'll pick a theme, put 5 stocks out there, say these are going to beat the market next 1, 2, 3, 5 years. And that's exactly what we're going to be doing next week. In the meantime, have a great week. Fool on.
As always, people on this program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. Learn more about rule breaker investing at rbi.fool.com.